Fraud risks. This module covers Section D, Fraud Risks of the Institute of Internal Auditors, IIA, Part 1 exam syllabus. This section represents 15% of Part 1. Welcome. Today we're delving into a topic of critical importance to any organization and everyone working in internal audit. Fraud. It's a word that carries deep connotations connoting deception and loss, but understanding fraud, its risks, its many forms, and how to detect it is essential to protecting organizations and maintaining integrity. This session is designed to provide you with a comprehensive understanding, building on the key concepts related to the Institute of Internal Auditors, IIA Certified Internal Auditor CIA exam, with a specific focus on fraud risk. 10.1 Fraud Risks and Types. Let's start with the basics. What exactly is fraud? The Institute of Internal Auditors, IIA, defines it very clearly. Fraud is any intentional act characterized by deception, concealment, deception, misappropriation of assets or information, forgery, or breach of trust committed by individuals or organizations for an unfair or unlawful personal or business gain. Note the key word here, intentional. Fraud is not an accident or a mistake, it is a deliberate act. For fraud to occur, three elements generally require: first, an intent to defraud; second, the commission of the fraudulent act; and third, the successful completion of the fraudulent act. The concept of fraud risk is closely related to fraud. It's not about the fraud itself, but rather the possibility of it occurring and the negative consequences it can have for an organization. Think of it as the shadow cast by the potential for dishonest acts. Understanding the fraud landscape is critical in today's world. It encompasses not only the various methods fraudsters use, but also the locations within an organization where fraud is most likely to occur. Furthermore, this landscape encompasses the broader technological, social, and economic trends that influence how and why fraud occurs. Understanding this landscape is essential if we are to build effective strategies to prevent fraud before it occurs, detect it quickly if it does occur, and respond decisively when it is discovered. One of the major factors reshaping this landscape is the proliferation of digitalization in our world. While technology brings tremendous benefits, it has also significantly expanded the scope for fraud to flourish. Think about it. The more computer systems there are, the more potential entry points for malicious actors. This makes large-scale, even global fraud more feasible than ever. Unfortunately, more entry points can sometimes mean less secure systems overall, especially if security measures haven't kept pace. When combined with other environmental risk factors, the likelihood of fraud increases. So, how do we identify these fraud risks within an organization? Fraud risk represents the potential for dishonest activities that could cause harm. Organizations actively look for specific factors that may indicate potential fraud. These could be unusual behaviors, odd transactions, or perhaps a perceived lack of oversight in certain areas. Often, a combination of factors is of significant concern, but sometimes just one factor can constitute a serious warning sign that warrants attention. The classic framework often used to analyze fraud likelihood involves considering three key factors, often called the fraud triangle. These factors are opportunity, the conditions that allow fraud to occur; pressure, the motivation or incentive that drives the individual; and rationalization, the justification the individual uses to make the act seem acceptable. Analyzing these factors can greatly help identify fraud risk. While the risk is certainly increased when multiple factors are present, remember that just one element can indicate risk. Where can you get information about potential fraud risks? It's not just about formal analysis. Valuable insights often emerge from a variety of sources. The employees themselves, who are often closest to the process. Internal and external auditors, whose job includes auditing processes and controls. Anonymous tips, perhaps via dedicated hotlines. Formal complaints from whistleblowers. Even outside parties such as vendors, suppliers, and business partners may notice things that indicate danger. Ignoring these risks is risky. Fraud can result in the direct loss of assets, physical items, financial resources, and increasingly valuable digital assets. But the damage often extends beyond the tangible aspects. It can significantly tarnish an organization's reputation and public image, undermining customer and stakeholder confidence. Therefore, effective oversight is critical. Once fraud risks have been identified, what should management do? Simply knowing the risks is not enough. Management has a responsibility to analyze these risks and respond to them in a way that effectively mitigates them. This includes designing a comprehensive risk response strategy and specific procedures specifically designed to identify them. Rated risks. Sometimes mitigating risks may involve making fundamental changes to an organization's activities or business processes, that is, designing a system that removes risks from the system. Management also needs to pay particular attention to developing responses to some particularly challenging scenarios. One, the risk of management overriding internal controls. Two, the risk of collusion, where multiple individuals conspire to commit fraud. And three, the risk of corruption. These actions often require approaches different from standard control mechanisms. Importantly, if fraud is detected, this is a signal that the risk assessment process itself may need to be revised. The assessment process must be robust enough to ensure that the necessary mitigation strategies are identified and effectively implemented. This creates a cycle. Analyzing fraud risk factors helps identify fraud risks, which informs risk responses, leading to reassessment of risks and ultimately effective risk mitigation. Let's talk about the impact of fraud. The financial losses can be staggering, reaching millions or even billions depending on the scale. But what is the true cost? It's often immeasurable. Think of the lost time and productivity spent investigating, correcting records, and dealing with the legal ramifications. Think of the damage to employee morale and the erosion of customer relationships. Because the impact is so profound, it's best for every organization to have a comprehensive anti fraud program. This program goes beyond detecting fraud after it occurs. It should include proactive elements such as fraud awareness training, robust preventative measures, and robust detection programs. Now, let's explore the different types of fraud. It's not a homogeneous concept. Fraudsters use a variety of tactics. One major category is asset misappropriation. This is essentially theft, stealing cash or other company assets such as supplies, inventory, equipment, or even sensitive information. The thief often attempts to conceal their actions, perhaps by manipulating accounting records. For example, someone might make fraudulent journal entries. Imagine purchasing an asset, but instead of properly debiting the asset account, the perpetrator debits the expense account to hide the purchase or facilitate the theft later. Within this category, we see terms like misappropriation, which specifically refers to embezzlement by someone charged with managing funds, such as a trustee. Misappropriation is typically used when employees divert company funds for their own personal use. Another specific type of cash theft is embezzlement. This occurs when cash is stolen before it is recorded in a company's books. A classic example is a cashier who accepts payment from a customer but pockets the cash and never records the sale. Then there's payment fraud. This involves schemes involving payments for things. This may include creating invoices for goods or services that were never delivered, ghost goods services, inflating amounts on legitimate invoices, or submitting invoices for personal expenses as if they were business related. Expense reimbursement fraud is similar, but focuses on employee expenses. This occurs when employees claim reimbursements for expenses that are either fake or exaggerated. Examples include submitting an expense report for personal travel that claims to be business travel, listing meals that were not actually provided, or inflating mileage claims. Payroll fraud involves false claims for compensation. This may manifest as employees claiming overtime for hours they did not actually work, or perhaps more elaborately, the creation of ghost employees, fictitious individuals added to the payroll, whose wages are then diverted by the fraudster. Auditors may use this method to periodically compare employee names on the payroll with actual employees they observe working, helping to identify these ghost employees. Beyond outright theft, there is financial statement fraud. This type of fraud is often more sophisticated and is usually perpetrated by management. The goal is typically to make a company's financial performance appear better than it actually is. This may involve overstating assets or revenues or understating liabilities and expenses. Why does management do this? It's often to meet the expectations of third parties such as investors or creditors, perhaps to raise the stock price or secure loans. Personal gain can also be a motivation. Executives may receive larger bonuses based on inflated earnings, be able to sell their stock options at a higher price, or sometimes use financial statement fraud to hide other illicit activities. Let's look at some specific examples of fraudulent financial reporting. One such technique is called channel stuffing. This technique involves shipping more product to distributors than they actually need, often near the end of the reporting period, and incorrectly recording these shipments as sales to inflate revenue figures. Another way, it is simply recording fictitious sales, perhaps by creating fake invoices for non-existent customers or transactions. Fraudsters may also manipulate the timing of revenues and expenses. This may involve recognizing revenue earlier than permitted by accounting standards such as US GAAP or IFRS, or delaying expense recognition to a later period, again violating established accounting principles. Another tactic is not recording impairment of assets when accounting standards require it. If assets lose value, accounting rules often require recognizing this loss, which reduces profit. Deliberately ignoring this is a form of misrepresentation. This is related to informational misrepresentation. Although it is often associated with financial statements, it generally refers to the presentation of any false information, usually to third parties. Corruption represents another major category of fraud. This involves the improper use of power or influence, often for personal gain. Bribery is a common example. Corruption can be difficult to detect through traditional accounting records because it often leaves little direct evidence. These schemes are often uncovered through tips or complaints, often from third parties who have observed or been affected by the corruption. The procurement function within an organization is often a hotspot for corruption risks. Let's analyze some specific forms of corruption and related schemes. Accounts receivable manipulation is a clever, albeit illegal, way to hide the theft of customer payments. It requires access to both incoming payments and accounts receivable records. Here's how it works. Employee A steals a payment from customer X. The company's books still show that customer X owes money. When customer Y sends a payment, employee A applies that payment to customer X's account to cover the shortfall. Customer Y's account is now delinquent. When customer Y pays, that money is applied to customer Y's account, and so on. This continuous cycle of covering the shortfall with subsequent receipts can continue until something breaks the chain. Perhaps a customer complains about an incorrect payment, the perpetrator takes a vacation, and someone else steps in and notices the discrepancies, or the perpetrator finally returns the stolen funds, which is rare. Bribery involves offering, giving, receiving, or requesting anything of value with the intent to influence an outcome. This influence may be to influence a decision, secure a contract, or obtain some other unfair advantage. Kickbacks are a form of bribery in which a vendor secretly pays a portion of the purchase price to an employee involved in the purchasing decision. Bribes may be offered to key employees, such as purchasing agents, often by intermediaries acting on behalf of outside vendors. A conflict of interest arises when an individual has an undisclosed personal economic interest in a transaction that could adversely affect the organization or its shareholders. For example, a manager agrees to a contract with a company secretly owned by a family member on terms that may be unfavorable to the employer. Diversion occurs when the transaction that was supposed to benefit the organization is redirected to an employee or external party. Imagine a salesperson directing a profitable opportunity to a competitor in exchange for a personal commission. The misuse of confidential or proprietary information is also considered fraud. This may include stealing trade secrets, customer lists, or other sensitive data for personal gain or to benefit a competitor. Related party fraud involves obtaining a benefit from a transaction with a related party, such as a family member or affiliate, that would not have been obtained in a fair and arm's-length transaction with an independent party. Tax evasion is the intentional act of falsifying a tax return to avoid paying taxes illegally due. Check fraud is a scheme that exploits the waiting period, the time between depositing a check and disbursing the funds. This occurs when someone writes a check that does not have enough funds to clear it at Bank A and then deposits that check into an account at Bank B. Before the check bounces at Bank A, they may write another lacking check from Bank B or another bank to deposit back into Bank A to cover the first check, creating an inflated fictitious balance using the waiting period. It is also useful to consider the level of fraud. We can generally distinguish between low-level fraud and executive fraud. Fraud committed by employees or line workers, which is low-level fraud, often involves theft of property or misappropriation of cash. The motivation for this may be personal financial stress, perhaps financial hardship, drug or gambling addiction, or simply a desire to acquire more material possessions. The soft, professional intro music fades slightly into the background and then gradually fades out. Stealing petty cash or merchandise, bypassing accounts receivable, and creating fake vendors are common forms of low-level fraud. Executive-level fraud varies. The incentive is usually to maintain or increase the stock price, obtain a large bonus, or both. This type of fraud is intended to benefit the organization. Executive-level fraud usually involves materially misrepresenting financial statements because earnings determine promotion and compensation. 7 symptoms of fraud. Fraud symptoms are warning signs or indicators that indicate potential fraudulent activity within an organization. These symptoms can take various forms and typically indicate violations that warrant further investigation. Recognizing these symptoms is critical for organizations as it can help detect fraud before it leads to significant financial loss or damage to their reputation. Reporting and investigating any observed symptoms helps maintain a culture of integrity and accountability within the organization. Common symptoms include document fraud, any manipulation of accounting records to conceal fraud. Examples include lifestyle disturbance, an unjustified increase in an employee's social status or level of material consumption. Behavioral disturbance, this may indicate fraud, such as a dramatic change in an employee's behavior. Guilt and other stress associated with committing and concealing fraud may cause noticeable changes in behavior. Warning signs of fraud. Warning signs do not indicate fraud but rather an opportunity. Here are examples of general risk indicators. Hidden assets such as hardware, software, inventory tools, equipment, or informal assets. Lost or damaged records and documents, piecemeal purchases when purchasing assets and supplies, clearances or refunds of excess amounts at the retail company's store. Rapid turnover of CFOs, executives, and employees, expenses that lack supporting documents, incorrect or incorrect entries in the accounting books, intentional double billing for products and services, overpricing of purchased products and services, computer software that is 1. Not patched properly, 2. In a timely manner, and 3. Not thoroughly tested, making it vulnerable to attacks. Computer peripherals and mobile devices are not properly secured. System controls are weak and ineffective. 8. Here are examples of investment fraud indicators: unlicensed investment sellers, brokers, and agents with forged credentials, investment offers, overstate returns and number of buyers, and understate risks. Investors are pressured to invest immediately with guaranteed returns. The following are examples of pyramid scheme indicators. No real product or service is being sold. Impressive product names may be used and high-tech services may be offered. Promises high returns in a short period of time. Easy income or passive income may be offered. Some signs of potential fraud. Even the most effective internal control systems can sometimes be circumvented, for example, through the collusion of one or more employees. Therefore, the auditor must be sensitive to circumstances that may indicate a heightened risk of fraud. Examples include the organizational structure is unstable or unnecessarily complex. The nature of the entity's operations provides opportunities to engage in fraud. Evidence of unusual patterns and trends in the entities or programs, contracting, procurement, acquisition, and other activities. Inadequate management control of compliance with laws, regulations, and policies. Poor management communication or support of ethical standards. Management's failure to demonstrate and communicate an appropriate position on internal control. Management's willingness to accept unusually high levels of risk when making important decisions. The entity has a history of violations, such as previous cases of fraud, questionable practices, or previous audits or investigations that resulted in findings related to questionable or criminal activities. Operating policies and procedures are not developed or are outdated. Lack or absence of key documents. Lack of accountability or asset protection procedures. The entity has a history of improper payments, evidence of false or misleading information, negative publicity for the company's product or service, declining stock prices or rising debt costs. 9. Although misconduct, such as waste and abuse of authority, does not necessarily involve fraud or illegal acts, it may indicate wrongdoing. The achievement of objectives, such as maintaining financial resources and managing budgets, may be affected. Employees in sensitive positions, such as cash management, are not rotated. Inappropriate combinations of job duties, such as cash collection and disbursement responsibilities. Lack of clarity in the lines of responsibility and accountability. Unrealistic sales or production targets. The employee refuses to take vacations or promotions. Failure to apply applicable controls consistently. Reported profits rise when competitors are experiencing an economic downturn. Then the high employee turnover rate in supervisory positions in finance and accounting. Excessive or unjustified use of a single source purchasing system. Unusual changes in account balances are detected through analytical procedures such as trend analysis. An example of this is a disproportionate increase in sales with an increase in the cost of goods sold, for example, a 30% increase in sales and a 3% increase in the cost of goods sold. The material requirements in the actual contract differ from those in the RFP. Petty cash transactions are not made using the impressed fund. The working arrangements are difficult to understand and are not practically applicable to the entity. Unusually high sales returns occur after the end of the year, indicating that incorrect sales may have been recorded near the end of the year. The period-end transactions are complex, unusual, or significant. The literature on risk indicators is well established and can be a useful aid to internal audit. However, not all risk indicators are associated with fraud. Furthermore, some may be difficult to identify or assess. The roles of Fraud Detection and Management Board of Directors roles determine appropriate orientations in senior management and the level of fraud risk acceptance. Monitor and evaluate management activities to combat fraud. Ensure the implementation of anti-fraud measures. Evaluate the effectiveness of the fraud risk control program. 10 management roles. The department has the primary responsibility for monitoring and controlling fraud prevention, deterrence, detection, and recovery operations. Management is responsible for establishing and maintaining effective controls at a reasonable cost. Assessing the organization's exposure to fraud. Study the use of technology to help manage fraud
Senior
risks.
managers are responsible for monitoring fraud risks and implementing controls. They are also responsible for designing the policies, procedures, and tools necessary to assess, analyze, and monitor fraud risks, including data analytics used to prevent or detect fraud. Establish escalation procedures in case of suspected fraud. Senior management may establish a separate department for fraud risk activities. This department works with internal audit and the legal department during fraud investigations. This department may be outsourced, or senior management may rely on internal audit to be more effective in fraud risk activities. Internal auditors must then ensure they maintain their independence and objectivity. The roles of internal auditors: professionalism. In its role as a third line of defense, the internal audit function provides assurance to the board of directors and senior management regarding the effectiveness of the organization's assessment and management of fraud risks. Auditor professionalism plays a role in preventing and detecting fraud. Aspects of professionalism include 1. Conduct, 2. Responsibility, 3. Skepticism, and 4. Judgment. Professional conduct is 1. Avoiding conduct that may bring the auditor's business into disrepute, and 2. Making a sincere effort to perform his duties in accordance with relevant technical and professional standards. Professional standards. Professional conduct. Professional responsibility is taking full responsibility for one's actions and omissions. Professional responsibility results in professional judgment. Professional standards. Professional conduct. Professional responsibility. Professional skepticism is questioning the reliability of information and critically evaluating it. The professional judgment is the auditor's use of his or her professional knowledge, skills, and abilities in good faith and with integrity to accurately gather information and objectively evaluate the sufficiency and appropriateness of evidence. Professional judgment includes exercising reasonable care and exercising professional skepticism. Professional standards, professional conduct, professional responsibility, professional discretion. Professionalism requires the auditor to be independent in appearance and thought. Appearance of independence is the absence of circumstances that might cause a reasonable and knowledgeable third party to reasonably conclude that the integrity, objectivity, or professional skepticism of the audit department or a member of the audit team has been compromised. Independence of mind is the mental state that allows audit work to be conducted without being influenced by any influence that impairs professional judgment, allowing the auditor to act with integrity and exercise objectivity and professional skepticism. Internal auditors are not responsible for all instances of fraud, but they should always be alert to the possibility of it occurring. Furthermore, Standard 4.2 requires auditors to exercise due professional care. They must assess the nature, circumstances, and requirements of their services. For example, this assessment includes the potential for material errors, fraud, non-compliance, and other risks that could affect objectives, operations, or resources. Other roles of the internal auditor. When planning any engagement, the internal auditor should assess which processes may be most vulnerable to fraud. The assessment considers the likelihood of fraud risks when 1. Setting objectives, 2. Evaluating control design, and 3. Selecting audit procedures. Internal auditors should obtain reasonable assurance that the objectives of the process under review have been detected. While documenting the study of fraud risks and their relationship to the specific audit work. Internal auditors must have sufficient knowledge of fraud to identify fraud indicators or warning signs. However, internal auditors do not typically perform specific procedures to collect this information. Their knowledge should include fraud characteristics and the methods used to commit it, various fraud schemes associated with the reviewed activities. The head of internal audit is responsible for ensuring that internal auditors have or have acquired the knowledge, skills, and other competencies necessary to perform their responsibilities, including providing assurance regarding fraud risks. Internal auditors should be alert to fraud opportunities such as control deficiencies. If significant control deficiencies are discovered, additional actions may be taken to determine whether fraud has occurred. Internal auditors must assess fraud indicators or warning signs, determine whether additional action is necessary, or recommend an investigation. Internal auditors should assess whether management actively oversees fraud risk management programs, adequate and timely corrective measures were taken in relation to any observed control deficiencies. The program monitoring plan is adequate. If appropriate, internal auditors should recommend an investigation. Auditor and management responsibilities. Management, not internal audit, is responsible for preventing fraud because it controls the organization's resources and activities. Management, not internal audit, is responsible for planning, designing, developing, and implementing fraud-related controls. However, auditors review and evaluate the adequacy, completeness, and appropriateness of fraud-related controls and inform management if they are ineffective. Neither auditors nor management can determine the legal intent of fraudsters. This must be determined by the judicial system. Management should promote a fraud-resistant culture. After implementing anti-fraud controls using computer technologies, audit objectives do not typically include fraud. However, auditors should be aware of fraud symptoms, risk factors, and key indicators. When auditors believe that fraud may have occurred, they expand the scope of audit work and audit procedures to detect fraud through further review, analysis, and investigations. Internal auditors should be cautious about allegations of fraud as they may not be credible. The source of the claim may be false or have ulterior motives. Internal auditors should be aware of the possibility of fraud in all audit engagements and take this into account during engagement planning, audit work, and communicating audit results. 10.2 Fraud controls. Fraud management program. Components of an effective fraud management program include the company ethics policy, fraud awareness, fraud risk assessment, continuous reviews, prevention and detection, investigation controls. Control is the primary means of managing fraud and ensuring that the elements of a fraud management program are in place and effective. Units 8 and 9 cover controls and their types in great detail. The principles outlined in these units apply generally to fraud controls. The Committee on Financial Supervisory Organizations, COSO internal control framework, can be applied in the context of fraud to promote an environment in which fraud is managed effectively. The control environment includes elements such as 1. A code of conduct, ethics policy, or anti-fraud policy to define the appropriate approach at the top, 2. Hiring and promotion guidelines and practices, and 3. Board oversight. The internal auditor should recommend that management issue a strong written statement of commitment to the organization's ethics. A fraud risk assessment generally includes identify and prioritize fraud risk factors and schemes, determine whether existing controls apply to potential fraud schemes and identify gaps, testing the effectiveness of fraud prevention and detection controls, document and report fraud risk assessment. Control activities are policies and procedures for business operations that include authority limits, supervision, and segregation of duties. Fraud-related information and communication practices enhance the organization's fraud risk management program and risk posture. Methods used include fraud awareness training and ensuring employee compliance with organization policies. The Control Department assesses anti-fraud controls through independent assessments of the fraud risk management program and its use. Key elements of fraud prevention include maintaining sound administrative behavior and establishing a strong ethical culture. The following are preventative controls. Asset protection protects entities from unauthorized use and disposition. Examples of this include theft of assets and intellectual property. Computer access controls, such as passwords and device authorization tables, are used to prevent improper use or tampering with data files and programs. The safety box system ensures that cash receipts are not stolen by postal staff or other employees. Certain policies and procedures, such as background checks, may prevent the hiring of employees with questionable personalities. The distribution of employee checks must be separate from supervisory approval of attendance cards. Ongoing supervision provides daily guidance to employees, resolves problems, reviews work, and provides training. Authority levels are limited controls. They ensure that any task that exceeds a predefined financial level receives immediate attention. They also include transaction monitoring activities that may include, for example, reconciliations, verification, authorizations,
Fraud is typically
and
discovered
approvals.
through employee observations, for example, through a whistleblower hotline, exit interviews, and employee surveys. Controls responsibility management has the primary responsibility for establishing and maintaining controls to prevent or detect fraud. Internal auditors should assist the organization by evaluating the adequacy, effectiveness, and efficiency of controls in responding to risks and promoting continuous improvement. Internal auditors are not responsible for designing and implementing fraud prevention controls. However, they are responsible for raising awareness of fraud and evaluating the organization's fraud risk management process. Namaba internal auditors as advisors can assist management in identifying and assessing risks and determining the adequacy of the control environment. Therefore, they should determine whether communication systems and practices, such as the fraud hotline, provide management with the necessary information about 1. The effectiveness of controls, and 2. The occurrence of unusual or fraudulent transactions. Members, internal auditors also have a unique position within the organization to recommend changes to improve the control environment. For example, they should monitor the annual disclosure of whether the Code of Professional Conduct applies to all senior officials. How fraud risks are managed within an organization depends on factors such as sector, and location, size, organizational structure and strategic objectives, governance, risk management, and internal control structures and systems, culture, approach, and values, management information systems and the use of technology, operating environment including regulatory oversight and legislation. Fraud awareness. Fraud awareness is understanding the nature, causes, and characteristics of fraud. Fraud awareness is developed through periodic fraud risk assessments, employee training, and communication between management and employees.
Employee training on fraud should be tailored to the fraud risks in each organization. Training typically covers the organization's values and code of conduct, types of fraud, and employee roles and responsibilities in reporting violations of ethical conduct. Fraud is essentially the falsification of transactions, therefore, an auditor's examination of transactions for fraud tests the claim of existence. Management overreach is management's circumvention of an entity's controls for illegitimate purposes, such as personal gain or enhancing the entity's image. Examples: by approving the sale of goods to a customer who does not meet the organization's credit policies in order to increase revenue. Requesting the financial controller not to close the books at the end of the period in order to manipulate the closing dates. Amend adjustment entries that have been reviewed and approved at the department level before being carried forward to reduce current period expenses. Changing accounting estimates without following normal procedures. While extending payment periods for some suppliers, contrary to established policy. Some controls aim to reduce the risk of management overreach. These controls may address significant and unusual transactions, especially those that result in late or unusual book entries. Book entries and adjustments in the financial reporting process at the end of the period. Related party transactions. The significant management judgment, reducing the incentives and pressures on management to falsify or inappropriately manage financial results. Methods to reduce management overreach include an effective and anonymous whistleblower program, a well-established ethical culture in the company, effective internal audit activity. The assessment of management overreach risk is part of the fraud risk assessment. This assessment is overseen by the board of directors or the audit committee. 10.2 Fraud controls. World of fraud risk management within organizations. Fraud can be a silent predator undermining stability, reputation, and financial health. But who exactly stands up to this threat? How do organizations build their defenses? We'll explore the essential roles played by various levels of management and the internal audit function and examine the controls they employ to protect the organization. It's a system of checks, balances, and vigilance, and understanding it is essential for anyone working in business governance or quality assurance. Let's start at the top with the fundamental role of management. Think of management as the primary guardians of an organization's fortress. They are directly responsible for overseeing and controlling day-to-day operations. Their mission is multifaceted. They must prevent fraud from occurring in the first place, deter potential fraudsters, detect any fraudulent activity that slips through their fingers, and ensure the organization's ability to recover in the event of an incident. It's not just about reacting, it's about proactive defense. A key part of this is establishing and maintaining effective controls. Controls aren't free, they come at a cost in terms of time, resources, and perhaps even some operational friction. So, management must strike a balance, implementing effective controls at a reasonable cost. It's a constant balancing act. They are also tasked with assessing the organization's most vulnerable areas to fraud, and understanding potential vulnerabilities is the first step to strengthening them. In our increasingly digital world, management must consider how technology can be harnessed to support these fraud risk management efforts, perhaps through sophisticated monitoring systems or data analytics. Further up the corporate ladder, we have senior managers. While general management oversees operational controls, senior managers take a slightly higher view. They are responsible for actively monitoring fraud risks identified by management and overseeing the implementation of necessary controls. Consider them the architects of the fraud defense strategy. They design the policies, procedures, and tools an organization uses to assess, analyze, and monitor fraud risks. This often involves leveraging powerful data analytics tools, specifically designed to prevent or detect suspicious patterns that may indicate fraud. What happens if fraud is suspected? Senior management ensures clear escalation procedures are in place so that suspicions are reported quickly and appropriately. Depending on the size and complexity of the organization, senior management may create a function specifically dedicated to fraud risk activities. This specialized team will work closely with other key departments, such as internal audit and legal, especially when formal fraud investigations are required. Interestingly, this fraud risk function doesn't always have to be internal. Sometimes it can be outsourced to external experts. Alternatively, senior management may rely more heavily on the internal audit department to play a more active role in these fraud risk activities. If this occurs, it is absolutely essential that internal auditors maintain their independence and objectivity, ensuring that their assessments remain unbiased. This brings us to the critical role of internal auditors, often described as an organization's third line of defense. Their primary role in this context is not to manage risks themselves, but rather to provide assurance. They report to the board of directors and senior management on the organization's effectiveness in assessing and managing fraud risks. They serve as the independent eyes and ears, evaluating the effectiveness of the defenses that management builds. An auditor's effectiveness depends largely on their professionalism. This is not just a buzzword, it encompasses several key attributes. The first is professional conduct. This means that auditors must avoid any behavior that might discredit their work or the profession. They are obligated to perform their duties honestly and in accordance with all relevant technical and professional standards. It is about maintaining integrity in every action. Professional responsibility is closely related to this. This means taking full responsibility for one's actions and, more importantly, for one's inaction. Recognizing a potential problem and failing to act appropriately constitutes a breach of this responsibility. This sense of responsibility is the foundation upon which sound professional judgment is built. Then comes professional skepticism. This is a fundamental pillar of auditing. This does not mean assuming everyone is dishonest, but rather maintaining a questioning mind and critically assessing the reliability of the information provided. Auditors cannot accept explanations at face value. They must investigate, questioning and seeking supporting evidence, especially in areas where the risk of fraud may be higher. This is based on professional judgment. It involves applying the auditor's collective knowledge, skills, and abilities diligently, in good faith, and with integrity. It means gathering sufficient and appropriate evidence and evaluating it objectively. The exercise of professional judgment inherently involves the application of reasonable care and the critical element of professional skepticism we just discussed. All of this is underpinned by independence. Professionalism requires that the auditor be independent in appearance and mind. Independence in appearance means avoiding situations in which a reasonable and informed third party might conclude that the auditor's integrity, objectivity, or skepticism could be compromised. Even if the auditor feels objective, the appearance of conflicting opinions can harm credibility. On the other hand, independence of mind is the actual mental state that allows the auditor to perform their work unaffected by influences that might cloud their professional judgment. It is the internal compass that ensures they act with integrity, objectivity, and skepticism, regardless of external pressures. It is important to clarify. Internal auditors are not responsible for detecting all instances of fraud. This is an impossible standard. However, they must always be aware of the possibility of fraud occurring during their work. Professional standards, such as Standard 4.2 mentioned in the text, require auditors to exercise due professional care. This includes assessing the likelihood of material misstatement, fraud, or non-compliance when planning and conducting their audits. In addition to this assurance role, internal auditors have other specific roles related to fraud. When planning any audit engagement, they must assess the processes under review for significant exposure to fraud. This assessment influences how they develop audit objectives, evaluate the design of existing controls, and select audit procedures to perform. Their goal is to obtain reasonable assurance that the objectives of the process being audited are being met, and that any significant control weaknesses which could open the door to fraud are detected. It is critical to document how they assess fraud risks and relate this to their audit work. Internal auditors need sufficient knowledge of fraud to recognize potential indicators, often called red flags. While they typically only perform fraud detection procedures when specific suspicions arise, their knowledge base should include an understanding of fraud characteristics, common fraud methods, and various fraud schemes relevant to the activities they review. The Chief Audit Executive, who leads the internal audit function, is responsible for ensuring that the team has the necessary knowledge, skills, and competencies to effectively address fraud risks. Auditors should be fully aware of fraud opportunities such as gaps or deficiencies in internal controls. If they discover material control weaknesses, they may need to perform additional procedures to determine whether these weaknesses have already been exploited through fraud. When warning signs or indicators of fraud emerge, auditors should carefully evaluate them. They should determine whether further action is warranted or whether a formal investigation should be recommended to management or the board. Their assessment extends to management's own actions regarding fraud risks. Auditors should assess whether management actively oversees fraud risk management programs, whether sufficient and timely corrective actions have been taken to address previously identified control deficiencies, and whether the ongoing program monitoring plan is adequate. If evidence suggests potential fraud that requires further examination, auditors should recommend an investigation. Let's pause here to emphasize the crucial distinction between the responsibilities of the auditor and management. Clearly, management, not internal audit, has the primary responsibility for preventing fraud. Why? Because management controls the organization's resources and activities. It is responsible for planning, designing, developing, and implementing specific controls designed to stop fraud before it occurs. So where do auditors fit into controls? Although they do not design or implement these controls, they review and evaluate the adequacy, completeness, and appropriateness of these fraud-related controls. They act as advisors, reporting to management if controls appear ineffective or inadequate. Internal auditors also play a role in assessing the broader control environment and raising awareness of fraud throughout the organization. They can assist management in identifying risks and recommending improvements, for example, by checking communication channels such as fraud prevention lines, provide management with effective information about the effectiveness of controls or unusual transactions. These lines may also monitor matters such as the annual disclosure of the Code of Professional Conduct for senior executives. It's also important to note that neither auditors nor management can definitively determine the legal intent of a potential fraudster. This determination, whether the actions meet the legal definition of fraud, is ultimately up to the judicial system. Although auditors typically don't design audits solely to detect fraud, they should always be aware of fraud symptoms, risk factors, and key indicators. If, during their work, they believe fraud is likely to occur, their responsibility shifts. They must then expand the scope of their work and implement specific audit procedures designed to uncover this potential fraud through more detailed review, analysis, and investigation. However, auditors must also be vigilant regarding allegations of fraud. Allegations may be false or even arise from ulterior motives, so they require careful and objective handling. The potential for fraud must be considered at all stages of the audit: planning, executing work, and communicating results. Now, let's talk about the structure that organizations put in place, the fraud management program. An effective program typically includes several key components that work together. These typically include a strong corporate ethics policy that outlines the right approach, ongoing fraud awareness initiatives, regular fraud risk assessments, ongoing reviews of controls and processes, specific activities aimed at prevention and detection, and clear procedures for investigating suspected fraud. Controls are at the heart of this program's success. They are the primary means an organization uses to manage fraud risks and ensure that all components of its fraud management program are in place and operating effectively. Frameworks, such as the COSO Internal Control Framework, provide a structured way to think about these controls in the context of fraud. COSO components here: The control environment determines the ethical approach. This includes having a code of conduct or ethics policy, sound hiring practices such as background checks, and effective oversight by the board of directors. Internal auditors often recommend that management issue strong written statements reinforcing a commitment to ethics. Setting the right tone at the top and fostering a strong ethical culture are key elements in preventing fraud. Fraud risk assessment involves systematically identifying potential fraud schemes and risk factors, prioritizing them, checking whether existing controls cover these risks, and identifying gaps, testing controls designed to prevent or detect fraud, and documenting the entire assessment process. Control activities are the specific policies and procedures embedded in business processes. Examples include setting clear boundaries of authority, ensuring appropriate supervision, segregating incompatible duties, such as separating check distribution from time card approval, performing reconciliations and verifications, and requiring permissions and approvals. Things like protecting assets from theft or unauthorized use, implementing computer access controls, passwords, authorization tables, using lockbox systems for cash receipts, or requiring signatures from authorized individuals for purchases are all preventative control activities. Ongoing supervision also serves as a control, providing day-to-day direction and oversight. Information and communication practices are essential to enhancing the effectiveness of a fraud risk management program. This includes fraud awareness training tailored to the organization's risks, typically covering values, a code of conduct, types of fraud, and employee responsibilities for reporting unethical behavior. It also includes ensuring that employees understand and comply with policies. Fraud detection often relies on this communication, with employee feedback through channels such as whistleblower hotlines, exit interviews, or surveys being common detection methods. Monitoring activities involve assessing the effectiveness of anti-fraud controls over time. This can occur through ongoing monitoring built into processes or through separate, independent assessments of the fraud risk management program. How an organization manages these fraud risks depends largely on its specific context, its sector, industry, location, size, structure, strategic objectives, culture, information systems, use of technology, and the regulatory environment in which it operates. A key part of the program is promoting fraud awareness, ensuring people understand the nature, causes, and signs of fraud. This is accomplished through periodic risk assessments, employee training, and open communication between management and employees, because fraud often involves the falsification of transactions. The auditor checking transactions for fraud is essentially a test of existence. Did this transaction actually occur as recorded? Management overreach is a particularly challenging risk. This occurs when management intentionally bypasses established controls for illegitimate purposes, such as personal gain or artificially improving the company's financial performance. Examples include approving sales to customers who do not meet credit standards simply to increase revenue, keeping books open past the end of the period to manipulate delivery dates, modifying approved accounting entries to shift expenses, changing accounting estimates without following due process, or granting preferential payment terms to suppliers in violation of policy. Because this risk often comes from the same people who design and implement controls, specific controls are needed to mitigate it. These controls may focus on scrutinizing significant or unusual transactions, particularly delayed journal entries, examining period-end reconciliations, carefully reviewing related party transactions, evaluating significant management estimates, and implementing measures to reduce incentives or pressures that might lead management to manipulate results. Methods for mitigating overreach include having an effective and truly anonymous whistleblower program, developing a strong ethical culture from the top down, and maintaining an effective and independent internal audit function. Assessing the risk of management overreach is an essential part of the overall fraud risk assessment, which is overseen by the board of directors or audit committee. Considering specific processes such as purchasing and their controls is vital. You need to ensure proper authorization, perhaps through signature lists that confirm who can initiate and approve purchase orders. These authorized individuals should be responsible for verifying the appropriateness of purchase details, price, quality, and quantity. Policies should ensure that purchases are made only from authorized vendors or under approved contracts and explicitly prohibit bribes or improper gifts. Even expenditures via credit cards or electronic payments should have controls such as expense type code restrictions to prevent misuse. Fraud risk management is an ongoing, dynamic process involving multiple layers of responsibility and a comprehensive set of controls. From the board of directors and senior management who set direction and strategy,
to management, who implements day-to-day controls, to internal audit, which provides assurance and promotes improvement. Each plays a vital role in protecting the organization. It requires vigilance, professionalism, skepticism, and a commitment
10.3
to ethical
Fraud
behavior at
investigation.
all
We're delving
levels.
into a critical area operating behind the scenes in many organizations, forensic auditing, and the complex fraud investigation process. It's an area where fine analytical skills meet investigative prowess, all with the goal of protecting assets, reputation, and the integrity of an organization. While we often hear about major corporate scandals after they occur, the real work begins long before they make the news and involves meticulous, methodical steps to uncover and address wrongdoing. So, let's explore this fascinating world together. We begin with the concept of forensic auditing. Think of it as a specialized branch of accounting and auditing, but one that directly intervenes in situations with potential legal consequences, whether civil or criminal. It's not just about crunching numbers, it's about applying accounting and auditing expertise to investigate potential fraud, support litigation efforts, or even provide expert testimony in court. The toolkit includes interviewing people, digging deep into records and data, and rigorous testing procedures. Forensic auditing utilizes accounting and auditing knowledge and skills in matters with civil or criminal legal implications. Examples include assignments involving fraud, litigation support, and expert testimony. Forensic auditing procedures include interviewing, investigation, and testing. Fraud investigation. When the internal auditor documents fraud, senior management must be notified unless a senior manager is involved. In this case, the audit committee must be notified. A fraud investigation must uncover the full nature and extent of the fraud. The investigation gathers sufficient information to determine whether fraud occurred, what losses were incurred, who was involved, and how the fraud occurred. Internal auditors, lawyers, and other professionals typically conduct fraud investigations. Investigation and resolution activities must comply with local law, and auditors must work effectively with legal counsel to become familiar with relevant laws. Management applies controls to the investigation. These tasks include 1. Establishing policies and procedures, 2. Preserving evidence, 3. Responding to findings, 4. Preparing reports, and 5. Communicating. These issues may be documented in an anti-fraud policy that internal auditors may assist in evaluating. Addresses policies and procedures, handles individual rights, qualifications of investigators, irrelevant laws, and how about disciplining employees, suppliers, or customers, including legal action. The powers and responsibilities of those involved in the investigation, especially the investigator and the legal advisor, must be clear. Internal communications related to the ongoing investigation should be minimized. The policy should specify the investigator's responsibility for determining whether fraud has occurred. The investigator or management decides whether fraud has occurred, and management decides whether to report it to external authorities. The internal audit function may be asked to assist in or lead fraud investigations. Such involvement may pose a potential threat to the independence of the internal audit function and the objectivity of internal auditors due to a real or perceived conflict of interest. The chief audit executive must develop approaches to address any barriers to objectivity. The internal audit function's responsibility for investigations should be defined in its charter and in anti-fraud policies and procedures. For example, internal audit may be how the principal acts as a resource or how avoids participation because he is responsible for evaluating investigations or lacks resources. Any role is acceptable if its impact on autonomy is recognized and managed appropriately. Internal auditors typically not only evaluate investigations but also advise management on the process, including control improvements. To be qualified, fraud investigation teams must acquire sufficient knowledge of HISHA and fraud schemes, investigation methods, and applicable law. The internal audit department may use internal staff, outsource, or both. An investigation plan is developed for each investigation. The principal investigator identifies other necessary knowledge, skills, and competencies. The process includes obtaining assurances that there is no potential conflict of interest with the persons under investigation or any employee of the organization. Planning should take into account the following and collect evidence using observation, interviews, or written statements. Documenting and preserving evidence, the legal rules for evidence and its business uses. Determine the extent of fraud, identify the methods used to commit fraud, assess the cause of fraud, identify the perpetrators. 21. All evidence obtained must be recorded chronologically in a log or inventory. Examples of evidence include letters, memos, and correspondence, paper or electronic, financial records, IT or systems access logs, phone records, customer or supplier information such as contracts, invoices, and payment information, and public records such as property records or business registrations filed with government agencies, when news articles, websites such as social media sites. The investigation must be coordinated with management, legal counsel, and other specialists. Investigators must exercise discretion, consistency, and knowledge of the rights of individuals within the scope of the investigation and the reputation of the organization. The level and extent of complicity in fraud must be assessed throughout the organization to avoid destroying or distorting crucial evidence and obtaining misleading information from individuals who may be involved. The investigation must ensure that the collected evidence is obtained and that chain of custody procedures are followed. Employee interviews, a fraud interrogation is very different from a regular interview. The purpose of a typical interview is to gather facts. In a fraud interview, the internal auditor has already gathered relevant facts and seeks to confirm them. An internal auditor should not accuse an employee of committing a crime in an attempt to extract a confession from him. If the accusation cannot be proven, the organization may bear legal liability. The accused is usually interviewed after most of the relevant evidence has been obtained. The goal is often to use evidence to obtain a confession. All information obtained during the interview must be accurately documented. All evidence must be subject to effective chain of custody procedures. The interview is conducted by two people, one of whom takes notes and may be a witness. The internal auditor should direct the conversation from general to specific. Open-ended questions are often used at the beginning of an interview, while closed-ended questions are used later when the interviewer is closer to obtaining a confession. Example of an open-ended question. Describe your role in the supplier approval process. Example of a closed question. Do you personally check for each resource that requires approval? The interviewer should use a non-threatening tone and closely monitor body language. The interviewer should also be aware of the suspect's phrasing choices. The employee should not be allowed to return to his/her regular workplace after the interview is over. Because an employee is aware of fraud inquiries, he or she may be tempted to destroy valuable evidence. Fraud testing includes a variety of techniques used by internal auditors to detect fraudulent activity within an organization. Some common techniques include computer-assisted auditing techniques. Auditors use specialized software to analyze data and identify suspicious patterns. This helps them detect any anomalies, such as duplicate invoices or payments, that may indicate fraud. Data mining. This method involves examining large amounts of data to discover unusual patterns or relationships that may indicate fraudulent behavior. By analyzing these patterns, auditors can identify potential fraud risks. Data analytics. This technique uses statistical and analytical tools to examine financial and operational data for any anomalies or trends that may indicate fraud. By interpreting and visualizing the data, auditors can gain insights that help them focus on high-risk areas. Some specific testing methods for detecting fraud include first-digit test. The first-digit test detects unusual data patterns resulting from human error, data manipulation, or fraudulent transactions. If the first digit in a financial account number or business transaction number is 1, it is likely a natural number, free from fraud. If the first digit is 9, the likelihood of it being a fraudulent number is higher. The digit 1 appears first 30% of the time, while 9 appears first only 5% of the time. In general, smaller numbers, 1 to 5, are more likely to be fraudulent than larger numbers, 6 to 9. The following conditions apply. If the combination of numbers 1, 2, 3, 4, and 5 appears, it is free of fraud in 78% of cases. If the combination of numbers 6, 7, 8, and 9 appears, it is fraudulent in 22% of cases. If the actual first digit analysis indicates that the numbers 6 through 9 appear more frequently than expected, an investigation into fraud or other irregularities is recommended. Exploratory sampling. Exploratory sampling is characterized by a specified probability of including at least one element that is rare in the population. This probability is used to detect fraud and avoid internal controls. Auditors can determine the probability of including at least one element with a particular characteristic in the sample if it occurs at a specified rate in the population. If the sample does not include an element with this characteristic, auditors can conclude that the occurrence rate of this characteristic is lower than the specified rate. Machine tools. Many automated tools are available for fraud testing. Computer-assisted auditing techniques can find anomalies in data by analyzing computer files. These files are searched for duplicate invoices or payments or other anomalies. Data query tools such as structured query language SQL are used to search a database for known conditions for data sequences and dependencies. Auditors can query many points within a database. Data mining examines massive amounts of data to discover anomalous patterns and unexpected correlations. Fraud control stress testing. Fraud control stress testing aims to determine their ability to withstand fraud pressure. Auditors need to identify or evaluate 1. A high-pressure work environment, 2. Business challenges, 3. Litigation, 4. Lack of experienced staff, 5. Employee and management attitudes that may increase the risk of fraud, 6. The opportunity for fraud to occur, and 7. Whether the stated ambitious goals and objectives are being achieved. Management can control excessive pressure using several tools such as rebalancing workloads, increasing resources, money and people, or outsourcing some non-core work. After completing the work, auditors need to determine who is causing excessive stress on employees. If management is the cause, the board of directors must impose controls on management. Reasoning test. An inference test determines whether a particular fraud claim is statistically significant, that is, whether statistical evidence supports the hypothesis that fraud exists. A random sample of fraud data is taken and the results are generalized to the population. Inference test. Sample population ground truth test. Ground truth testing can verify the presence of fraud after studying a fraud-related policy theory and whether compliance with or violation of the policy has occurred in practice, actual practice. Any gaps between theory and practice can be drawn. Therefore, ground truth testing is superior to inference testing because it is based on real facts, evidence, and direct observation rather than sample data. Financial data analysis. If financial statements are prepared fairly, changes in account balances from period to period should have logical explanations. Manipulating financial statements to hide missing assets or other problems may mask fraud. Using ratios and trend analysis, fraud examiners or auditors can identify unusual relationships that indicate errors or irregularities. The balance sheet and income statement can be analyzed in 3 ways to detect fraud and other types of errors. Financial data. 1. The current period can be compared with the results of previous periods to look for any unusual relationships. 2. It can be compared with similar information from other companies or with industry statistics to detect any unusual relationships. 3. It can be linked to non-financial data to determine whether the numbers are reasonable. When searching for fraud, auditors must be curious and question abnormal information. There are analytical relationships between representations in financial statements and non-financial measures. Report fraud. The head of internal audit is responsible for fraud reporting. This report consists of various oral or written communications, interim or final, addressed to management or the board of directors regarding the status and results of fraud investigations. An official statement may be issued upon completion of the investigation, including HANAB timeframes, HANAB notes, HANAB conclusions, HANAB the decision, and HANAB corrective actions to improve controls. It may be necessary to write it to protect the identities of some of the people involved. The needs of the board and management, legal requirements, policies, and procedures must be taken into account. The draft of the proposed final report must be submitted to legal counsel for review. To be covered by attorney-client confidentiality, the report must be addressed to counsel. Any significant fraud incident or an incident that causes internal auditors to question the level of confidence placed in one or more individuals must be reported in a timely manner to senior management and the board of directors. If financial statements issued a year or more in advance are likely to be adversely affected, senior management and the board of directors must also be informed. 25. Resolving fraud incidents. The solution includes identifying the actions to be taken after the investigation is completed. The responsibility for resolving fraud incidents lies with management and the board of directors. The solution may include the following: end the case of people who have been proven innocent or who have reported a problem. Disciplining an employee. Request for voluntary financial compensation. Termination of contracts with suppliers. Report the incident to law enforcement or regulatory authorities. Encourage them to prosecute violators and cooperate with them. File a civil suit to recover damages. Submit an insurance claim. Submit a complaint to the professional association to which the perpetrator belongs. Recommend improvements in oversight, reporting fraud incidents. Management or the board of directors determines whether to report the incident to external parties after consulting with individuals such as legal counsel, human resources staff, and the head of internal audit. The organization may need to notify government agencies of certain types of fraud. It may also need to notify insurance companies, banks, and external auditors of fraud cases. Internal communications are a strategic tool used by management to enhance its position regarding integrity and to communicate the importance of internal controls. Opinion on fraud controls management or the board of directors may request the internal auditor to provide an opinion on internal controls related to fraud. Expressing an opinion on controls related to fraud is acceptable, but it is inappropriate for the internal auditor to express an opinion on the responsibility of a suspected fraudster.
Thank you for watching, and as always, continue learning, stay curious, and we'll see you next video.